Question 71. Which of the following statements is most likely correct regarding derivatives? A may have an indefinite lifespan. That's going to be incorrect. All derivatives, options, futures are going to have some expiration date or date where the obligation needs to be met in the case of futures or forwards. They're not going to go on indefinitely. B, transform the nature of a party's risk exposure. So they can change or transfer the nature of a party's risk exposure, but it's being transferred to a different party. It's not transforming the nature of that exposure. It's transferred, not transforming. So we can roll that out. And then C, take their value and characteristics from the underlying. That's going to be correct. It's called a derivative because it derives its value from the underlying. Answer C. Question 72. In which of the following private equity strategies is the current management team being replaced and the acquiring team is involved in managing the company? We've got A, venture capital, which we can rule out right away. In venture capital, this is usually very early stage startups, and there might not even be a main management team in place. It might just kind of be a founder, a couple other people, and an idea. So when you're that early, the private equity firm likely doesn't want to replace the founder since they're kind of the visionary and the ones that need to get the product or idea going. So we've got management buy-ins or management buyouts. So management buyout, this is when the current management at the company is going to buy the company. And so in that case, they're going to buy the company and then keep themselves in place as the management. So we can rule that out. So the term we're looking for is management buy-in, which is kind of what is talked about here. Private equity firm comes in, buys the company, brings in new management to manage that company. Answer B. Question 73. Which of the following is least likely a characteristic of hedge funds? So we've got least likely here. So two of these are going to be characteristics of hedge funds and one will not be. A are almost always closed-ended. So this looks like it's going to be our answer right off the bat. Hedge funds are normally going to be structured as open-ended, meaning that you buy in at NAV and then new shares are created, or on the opposite side, you sell out at the NAV and shares are retired. Whereas in closed-ended fund, you're going to be buying in and out of the set number of shares, which is not how they're structured. B, impose restrictions on redemptions. We can rule that out since that will be a characteristic of hedge funds. They may have some type of gate or redemption restriction on whether that's time or amount of your capital for a certain period of time. C, are generally set up as a private investment partnership open to a limited number of investors willing and able to make large initial investments. We can rule that out since that's also a characteristic of hedge funds. Answer A. Question 74. A hedge fund has a beginning year value of $200 million, 2% management fee, and 20% incentive fee with a hard hurdle rate of 10%. The fees are paid at the end of the period, and the incentive fee is calculated net of management fee. If the ending value of the fund is $300 million, then the total fee of the hedge fund is closest to. So, first thing we're going to do is calculate the management fee. So that's going to be pretty straightforward. It's going to be this ending value of 300 million. Multiply that by 2%. We get a management fee of 6 million. So then for the incentive fee, we're going to have profit above the hurdle minus the management fee and then multiply that by 0.2%. The hurdle is going to be calculated as 10% times the beginning year value of 20 million. So that's going to be, or of 200 million. So that's going to be 20 million. And then our overall profit is going to be 100 million. And that's just the 300 million minus 200 million. So from here, our profit above the hurdle is $80 million. And then since we're calculating management fee net, or calculating incentive fee net of management fee, we need to subtract out the 6 million. So we're going to have 80 million minus 6 million, which is 74 million. Multiply that by our incentive fee of 20%, gives us 14.8 million. Then last step is just adding those two fees together since we're looking for total fee. So 14.8 plus 6 million gives us 20.8 million. And that's going to line up right there with answer C. Question 75. A European call option on a non-dividend paying stock has 4 months to maturity. The exercise price of the option is $100 and the risk-free rate is 1.5%. If the current underlying price is 105 and the current call option price is 6.5, the time value of the call option is closest to. So we're going to calculate the value of this call option using some of these given numbers. So 4 months to maturity, 1.5 risk-free rate, exercise price, current price. And then we're going to compare that to the current call option price of $6.5. And basically the difference between what we calculate as the value and the 6.5 is going to tell us what our time value is. So to calculate the value of the call, we're going to take the current price, and then basically we need to discount the strike price back to the present value. So that's going to be, I should have put parentheses around all of this here. So our X is going to be strike price here in this case, and then that's going to be 1 plus R. Our R is going to be 1.5%, and then that's going to be raised to the minus little t divided by t, so little t being our 4 months to maturity, and then big T being total months for the year, so 12. So this is what that ends up looking like in full. And then from here we get, it's about 5.5. And so we end up subtracting 6.5 from about 5.5 gives us 1.0049. So whatever is closest to that is going to be our time value. So we've got 1, 5.5, or 12. So answer A is going to be closest there. Question 76. Which of the following sources of venture capital financing can be used to support a major marketing campaign of a company that has recently initiated commercial production and sales? A, seed stage financing. We can probably rule this out since at seed stage, this is where it's going to be at more of the idea phase. So they probably don't have commercial production and sales necessarily. So it's not going to make sense to do a major marketing campaign. B, later stage financing. Probably our best answer so far. In the later stage, companies are obviously later in their company life cycle, so it's very possible they'll have production and sales, and it may make sense to kind of start doing more enhanced marketing to increase market share and increase sales. C, formative stage financing. So formative stage is going to be a more overarching stage that includes seed stage and early stage. So again, it's going to be too early in the process. I think that B, later stage financing, is going to be our best answer here. Answer B. Question 77. Which of the following is most likely accurate regarding direct real estate investing? Direct real estate investing. A, requires expertise in the local real estate market. I'd say that sounds pretty accurate so far, so I'm going to go ahead and circle it. If you're going to be buying properties in a market and you're buying those properties one by one, you should probably have some type of expertise or extra knowledge on that market, or else you're not really going to have an edge or probably be able to do well from an investment standpoint. B, eliminates the need for management of the property. That is certainly not going to be accurate. If you're buying properties directly, you are certainly going to need to either manage them yourself or put in place some type of management. Regardless of who does it, you're going to be the one responsible for getting that in place at a minimum. And then C, requires less capital than indirect real estate investing. We can rule that out as well. It's going to require a lot more capital, especially to become diversified. If you're going to be buying property by property. In indirect real estate investing, you could buy something like a public REIT for, a few $100s per share or whatever the REIT is selling at. So that's going to be far less capital requirement than direct real estate investing. Answer A. Question 78. A retail options trader bought a single call option on Avalara Tech's stocks. That's a mouthful. At the strike price of $25 for the option premium of 3.2. If the current trading price of Avalara Tech is 21.8, the option is most likely in the money, at the money, or out of the money. So we've got a strike at $25. We're currently at $21.8. And the last key thing here is this is a call option. So for call options, if the current price is below the strike price, that's going to indicate that we are C, out of the money. To be in the money, this would need to be above the strike price. So it would need to be 26, 27, 28, 30, anything above. And then B, at the money, this would indicate that the current price is 25 or pretty darn close to it. I would say if it was 25.5 or 25.25, you would probably say it's at the money, not in the money. But we're pretty far out of the money here, so no gray area there. And so we can confidently go with the answer C, out of the money. Question 79. Which of the following is least likely an activity of the risk management framework? So we've got least likely, so 2 of these activities should be part of the risk management framework and 1 will not. We've got A, performing strategic risk analysis. That sounds like it would certainly be part of this framework. I think we can probably rule that out. B, predicting expected political risk. The risk management framework isn't necessarily centered around predicting types of risks. We want to be prepared and informed to manage risks, but it's more so about making sure we're ready to handle any or different types of unexpected risks, not really predicting expected things. So I'm leaning towards B so far. And then C, establishing risk governance policies. That's also going to be part of this framework. So we can go ahead and rule out C as well and confidently go with answer B. Question 80. Which of the following are most likely components of an investment policy statement? So we've got 3 different components here, and then our answers are kind of 1 and 2. So these 2 are parts of the IPS. 1 and 3 are parts of the IPS, or all 3 are. So number 1, duties and responsibilities of the investment manager. That is certainly going to be part of the IPS. It's going to be important for the investment manager to know what their duties and responsibilities are. B, procedures to update the IPS. That's also going to be important. We want to make sure we have some type of process in place for this so that not anybody can go ahead and do it, and it can't be done too frequently where we're moving the portfolio around or objectives around too much. There needs to be some type of procedures process in place for this. So 1 and 2 are good so far. And then 3, investment expertise of the investment manager. This is going to be a little outside the scope of the IPS. This is going to fall more under kind of the investment philosophy and kind of credentials and background of the manager. It's not necessarily something that can be changed. It's just kind of a matter of fact. And the IPS is more so kind of outlining who is, what parties are involved, what parties are responsible for certain things, and what is kind of constrained or not constrained. This is more so just kind of factual information about the investment manager. So we can rule out anything that has answer 3 in it, which is going to be B and C, and we will go with answer A. Statements 1 and 2 are part of the IPS.